Celsius has been one of the hottest stocks in the market since 2019. From 2019, Celsius has produced over 3,000% returns for its shareholders and absolutely crushed the S&P 500. However, the stock is currently in a 47% correction from its all-time highs back in May. So just over the past couple of months, the stock has lost nearly half of its value. This correction has also caused many investors to ask me what my opinion is on the stock today, and if I think that the stock is looking cheap. So I went through Celsius's investor presentation, its most recent earnings report, and its transcripts, and in today's video, I want to share everything that I found with you, and if I think that the stock is looking like a buy today. Before we get into the video though, I want to let you all know that I will be doing a live stream over on the Stock Unlock YouTube channel at 2 p.m. Eastern tomorrow. If you would like to come and join the live stream and ask me questions, then go subscribe to Stock Unlock so that you can be notified when we start the live stream. But with that being said, let's now hop into the video. Now, for those of you who may not know, Celsius is an energy drink company that is directly competing with Monster and Red Bull. And in 2022, Celsius signed a distribution agreement with Pepsi and received a $550 million investment from Pepsi as well. This resulted in Pepsi owning 8.5% of the company, and incentivizes Pepsi to ensure that Celsius continues to grow and remain a successful company. Celsius has been stealing significant market share from the two industry leaders as well, which again are Monster and Red Bull. Since the first quarter of 2022, Red Bull's market share has declined by 2.2%, and Monster's has declined by 3.2%. At the same time, Celsius market share has gone from 3.6% to 11.4%. So Celsius is clearly taking market share from the largest energy drink companies. The energy drink industry is continuing to grow as well. The household penetration of energy drinks has increased from 64.8% at the beginning of 2023 to 70.5% at the end of 2023. So more and more households within the US are starting to consume energy drinks. The energy drink market is also outperforming the overall beverage market. Total beverages saw a decline in sales in 2022, 2023, and so far in 2024. At the same time, energy drink sales increased every year over the past 5 years. Celsius has single-handedly contributed 47.2% to the overall energy drink industry sales growth in 2024 as well. So almost half of the entire energy sales industry growth is coming from new customers buying Celsius energy drinks. The company is also still expanding internationally. Canada and the UK are new markets that Celsius has expanded into so far in 2024. And throughout the remainder of the year, it is expecting to get its energy drinks in France, Australia, and New Zealand. These will be brand new markets for Celsius, and will most likely lead to continued sales growth and market share gains for the company. Celsius has been seeing ridiculous growth as well. In the first quarter of 2024, it grew sales by 37% year over year. We can also see that its North America sales grew by 37%, international sales grew by 43%, its gross margin was also 51.2%, which is an increase of 740 basis points year over year. Net income increased by 89%, and diluted earnings per share grew by 108% year over year. So Celsius's business is growing incredibly well, its margins are expanding, it is profitable, and its profits grew by over 100% year over year. However, Celsius's growth did slow down in the first quarter. For example, in the first quarter of 2023, the company grew its revenue by 95% year over year. So a 37% year over year growth rate is actually a significant decline in overall revenue growth, relative to how insanely quickly the company has been growing over the past couple of years. This is natural and kind of expected though, because as businesses expand, it becomes more and more challenging to maintain high rates of growth. On Celsius's Q1 conference call, they did say that the results were very strong, but revenue growth would have been even higher if their largest customer wasn't going through a large inventory movement. And due to these inventory movements, Celsius did not see as many sales. So in the next few quarters, we could see a slight reacceleration to revenue growth for Celsius. But overall, its year-over-year revenue growth rates are down quite significantly. Now, I went over to a compounded annual growth rate calculator to kind of show what I mean by it's natural for businesses' growth rates to slow down as they become larger businesses. And in this calculator, we can see that I inputted Celsius's trailing 12 months revenue of $1.41 billion, and I wanted to see what would happen if Celsius can compound its revenue at a 95% annual growth rate over the next 10 years. And the result is that Celsius would be producing $1.1 trillion in revenue by the year 2034 at a 95% annual revenue growth rate. This is simply impossible, and this is not going to happen in any world that we live in. So this is what I mean right here. Celsius's revenue over the past 3 years has been growing by 95 to over 100% annually, but these revenue growth rates are simply unsustainable, and it is just impossible for the company to continue growing at this rate. So then I wanted to play around with the calculator, and I entered in a 30% annual growth rate to Celsius's revenue over the next decade. And I got $19.4 billion in revenue for the year of 2034. Now, in my opinion, this is still too much revenue for the year of 2034. And the reason is because the entire energy drink market size today is $44 billion. So a 30% compounded annual growth rate to Celsius's revenue over the next decade would basically give them about 40% of the entire energy drink market share, which I don't think is going to happen. It would ultimately result in Celsius having the #1 market share in the energy drink category by a wide margin. Now, I am not saying that it is impossible for Celsius to become the #1 market leader in the energy drink industry, especially if the company can't continue to take market share, but $19.4 billion is a very high amount of revenue. In the trailing 12 months, I believe that Monster has produced about $7.4 billion in revenue, and they are the second in this industry. So Celsius would almost have to triple Monster's existing revenue today over the next 10 years. And I just think that this is way too high of a ticket. And I just think that this is way too optimistic and probably is not going to happen. So I did one last calculation with a 20% compounded annual growth rate to revenue over the next decade, which gives us $8.7 billion in revenue. I think that this is much, much more realistic, but you still have to consider that $8.7 billion in revenue is more than Monster is generating today. But I also think that this is still quite optimistic. I think that this is kind of like the best absolute perfect case scenario right here over the next decade. And a 20% compounded annual growth rate to revenue is still very impressive. Now, if we also head over to Stock Unlock and take a look at the analyst projections for Celsius's revenue growth over the next 5 years, we can see that by 2028, analysts are expecting Celsius's revenue to grow at a compounded annual growth rate of only 18.3%. And they are expecting Celsius's overall revenue growth rates to start declining quite significantly from 2026 to 2028. And again, this is just how the nature of businesses work. As they grow and compound and scale, it becomes more and more challenging for the business to actually maintain ridiculously high growth rates. So analysts kind of seem to be thinking the same thing, and they are expecting Celsius's overall revenue growth to start decelerating by the year of 2028 as well. Now, the next thing that I want to do is go through Celsius's balance sheet really quickly. And right here, we can see that the company has $880 million of cash and cash equivalents and about $1.3 billion of total current assets. Now, the company also has $315 million of total current liabilities. And relative to the company's $880 million in cash and cash equivalents, what this means is that they have more cash than current liabilities, and they also have more cash than total liabilities by about $400 million. So to put this in perspective, Celsius could use its existing cash position to wipe out all of its liabilities and still have $400 million left over. So this company is in a very strong financial position, and they should not be in any financial stress anytime soon. This is a very healthy and clean balance sheet. Next, let's head over to Celsius's most recent cash flow statement. And right here, we can see that stock-based compensation in the most recent quarter was only $3.6 million. Now, relative to the amount of operating cash flow and profits that this business produces, this is a low amount of stock-based compensation. And if you have been watching my channel, then you know that I think that this is a very good thing to see. And I love to see this actually. So I love seeing low stock-based compensation. We can also see that accounts receivable was negative $18.6 million on this quarter, whereas last year in the first quarter, it was negative $109 million. This basically means that Celsius has companies that owe them money, and this is actually harming operating cash flow right now, but not nearly as much as it did last year. Accounts payable is also negative $3 million versus negative $19.7 million last year. So basically there is about $100 million of additional cash flow coming in the first quarter of 2024 versus the first quarter of 2023. And this is why last year in the first quarter, they had negative $14 million of operating cash flow versus positive $135 million in operating cash flow for the first quarter of 2024. And when we normalize all of these numbers right here, the operating cash flows did grow by about $20 to $40 million year over year, which is still very strong growth, but it's not as dramatic as it seems at face value. And I just wanted to point that out. Now, we can still see that the company did produce about $135 million in operating cash flow, which is great to see because it means that this is a profitable business and cash is coming in consistently, which is a great thing to see. Next, we can see that the capital expenditures, which is the purchases of property, plant, and equipment, was only $4.5 million on the quarter. Now, what this means is that basically all of this operating cash flow became free cash flow for the business. And the company produced about $130 million in free cash flow for the first quarter of 2024. That again is a very good thing to see. My next question is, what does the company do with its cash flow? And it's not buying back shares or paying a dividend, so it's basically just stacking up cash. And right here we can see that its net increase in cash and cash equivalents was about $123.5 million on the quarter. So Celsius increased its cash position by over $120 million on the quarter through organic profits, which again, I think is a very good thing to see. So this cash flow statement is very clean. I think that it is a really good cash flow statement actually. You got low stock-based compensation, you have a lot of cash coming in from the operations, you have low capital expenditures, a lot of free cash flow, and the cash position is growing significantly through organic profits. So there's not really anything here that is a red flag for me. So now let's head over to Stock Unlock's freeform tool, and I want to take a look at Celsius versus Monster, which is its #1 public competitor. And we're going to take a look at the price to sales ratio, which I don't love using. But since Celsius was an unprofitable business for a large period over the past decade, this is really the only metric that we can compare. So right now we can see that Celsius is trading for a price to sales ratio of 8.3 and Monster is trading for a price to sales ratio of 7.16. So Celsius, based on this, is selling for about a 20% premium to Monster right now. But Celsius is also growing significantly quicker than Monster. Now, what I also found interesting is Monster's 10-year average price to sales ratio is 8.7, and Celsius is actually trading below Monster's 10-year average price to sales ratio. So I think that that was also pretty interesting because, again, Celsius is actually growing quite a bit more rapidly than Monster. Now, if we take a look at these two companies' revenue growth as well, we can actually see that Monster's revenue, the blue line, is still growing very, very nicely and healthy. And we can see that Celsius's revenue in the most recent quarter did see a pretty significant slowdown to that trend that the company has been on. Because again, they saw 37% year over year revenue growth in the first quarter, whereas the company was historically growing at 90% plus year over year. So Celsius's revenue growth has been slowing down, and time will tell if Celsius's revenue growth continues to slow down or if it re-accelerates and can continue to catch up to Monster. But overall, we can still see that Monster's revenue growth is very healthy, and Celsius still has a long way to go before it actually overtakes Monster as well. Now, another thing that I want to quickly take a look at is these companies' free cash flow margins, because Monster's average free cash flow margin over the past decade has been about 22%. And in the trailing 12 months, both of these companies have a 19% free cash flow margin. So it seems like the free cash flow or profit margins within this industry, when the companies are stable, is about 20 to 22%. And that is what I am going to factor in when we do our discounted cash flow calculation here of Celsius going forward. So I want to project out Celsius's free cash flow over the next decade at a 20.4% annual growth rate. And the reason that I am using a 20.4% annual growth rate is because it gives us $1.73 billion in free cash flow produced for the year of 2034. Now, how I got that $1.73 billion in free cash flow produced for 2024 is I took the $8.7 billion in revenue that we found earlier in the compounded annual growth rate calculator, and I multiplied this by a 20% free cash flow margin, which gives us about $1.74 billion in free cash flow for the year of 2034. So that's how I came up with this number right here. So if Celsius can actually grow its revenue at 20% annually over the next decade and maintain a 20% free cash flow margin, then this will be the growth rate to the overall free cash flow. Now, what I'm also saying is that by 2034, Celsius's price to free cash flow will be about 30, which is more in line with Monster and how it has traded historically as well. And in this scenario, we get a compounded annual growth rate to the stock price of about 16% annually. So if Celsius can actually grow its free cash flow by 20% annually and maintain a 30 price to free cash flow, then the stock could deliver market-beating returns of about 16% annually. Now, I need to make it clear, though, that in my opinion, This is like the Goldilocks, everything goes perfect for Celsius over the next decade scenario. So from Celsius's current price today, if everything goes perfect, then in my opinion, it could deliver about 16% annual returns over the next decade. So now let's lower the annual free cash flow growth rate to 15% and maintain that 30 price to free cash flow, and we get a compounded annual growth rate of about 10.7%. This is, in my opinion, a lot more realistic, but a 15% annual growth rate to free cash flow I do still think is on the optimistic end, and a 30 price to free cash flow is a pretty high price for a business in this market as well. So I do still think that this is quite optimistic right here. Now, if we lower the metric down to 12% annual free cash flow growth, and the stock maintains a 25 price to free cash flow, then we can see that the stock will produce about 6% annual returns, and the fair value will actually be below where the stock is currently trading. And the reason that I am showing you all of these different calculations right now is to kind of get you thinking about, what do you think Celsius's business can produce over the next decade? What price ratio do you think the stock will trade for? And what do you think is actually realistic? And in my opinion, I think that a 12% annual growth rate and a 25 price to free cash flow is a lot more realistic for what this business will achieve over the next decade. And based on my opinion, the stock will only deliver a compounded annual growth rate of 6%, which is below what I want, and the fair value is below where the stock is currently trading. And for those reasons, I personally think that Celsius is trading way too high for me to be interested in the stock today. And basically, for this stock to be considered fair value right now, you have to believe that it will continue to grow its free cash flow by 15% annually for 10 years straight and trade for a 30 price to free cash flow, which I do think is a high price ratio, especially when the business actually matures and its growth rates do slow down. And I, again, think that these numbers right here are too optimistic, and this is still just to deliver a 10.7% annual return, which is basically in line with the historical averages of the S&P 500. So for these reasons, I think that Celsius is too expensive for me. It's also trading for a price to free cash flow of 45 today, which basically means that this stock, in my opinion, is selling for no margin of safety with an only 2% free cash flow yield. So it's not selling for a margin of safety. In my opinion, the stock is still pricing in what I believe are very optimistic projections over the next decade. And for those reasons, I would like Celsius to come down quite a bit more before I become interested in it myself. However, in terms of this business's fundamentals, it does have great growth, it is very profitable, and it does have an amazing balance sheet. It just doesn't have that margin of safety that I look for in my own investment strategy. And for that reason, I am personally not interested in it quite yet. That being said, if the company can actually continue to grow its revenues by 15 to 20% annually over the long term, maintain that free cash flow margin of 20%, and trade for that 30 price to free cash flow, then it could still deliver market-beating returns from where it is currently trading over the longer term. But again, those numbers are a little bit too optimistic for me today, so I am going to be sitting on the sidelines unless this one does continue to come down. But overall, that is my opinion on Celsius today. Let me know if you did enjoy this video, and if you did enjoy the video, also please leave a like on it. I'm also doing my best to clean up all of the spam comments in my comment section, and I will be leaving a pinned comment down there. So please leave a like on the pinned comment if you appreciate me spending my own time going through all of the comments, responding to you guys, and making sure that all of the bots and spams are gone. And lastly, if you do want to stick around and see more stock market related content, then please consider subscribing to my channel. Earnings season is coming up, and I do my absolute best to post as many earnings videos as possible right after businesses report. So like when Google reports, when Apple reports, Amazon, Meta, I do my best to go through the earnings reports and get videos out on the same day. So if you want to stay up to date with all of the earnings reports as they come out, then again, please make sure to subscribe to my channel to stay up to date with all of those videos. But with that being said, that is going to wrap up the video for today, everyone. So thank you so much for watching. As always, I truly do appreciate it, and I really hope to see you all again in my next one.